Hi friends, in this video we will talk about the difference between an investor and a speculator. Generally, a lot of us invest in stocks and we believe that we are actually investing in stocks. But the way we behave in the stock market tells us that if we are actually investing or we are speculating. For sure, speculating is not advisable, but we behave as a speculator. In order to prevent us from acting like a speculator, we should first know what is a speculative behavior and how one can distinguish between an investment activity and a speculative activity. So in order to establish this, we will consider these 5 points. And on basis of these 5 points, we can analyze ourselves that whether we are acting as an investor or as a speculator. So point number one, self-research. Whenever you are buying a stock, if it is driven by self-research, only then it can be called as an investment activity. Otherwise, it will be a speculative activity. So you have to do a self-research and then buy a stock. If you're buying a stock, but when you heard a name on a news channel or some friends of yours suggest you that this is a good stock you should buy, if you heard the name on a maybe on a WhatsApp group or on a Twitter group and you are buying that stock based on that advice, you are actually speculating. So don't buy stocks on others' advice. Buy stocks on self-research only. And if you're buying a stock on self-research, only then you are investing. Otherwise, you are speculating. Now, the point number two is the type of research you are doing. Let's say you are doing a stock research using technical analysis and you are buying a stock based on that technical analysis. You are actually speculating. Unless and until you buy a stock by analyzing the underlying business behind it, you are actually speculating. So if you want to invest, you have to analyze the underlying business behind that stock. If you're buying a stock of, let's say, Britannia Industries, you must know what is the business model of Britannia, how much revenues it has generated in last 10 years or 5 years, how much profits it is making, how profitable is the business, is the net worth of the company good enough, are the assets of the company growing over time, what is the return on assets for every rupee of asset it is investing, how much profits it is generating, is the cash flow of the company good enough, does it generate any free cash flows, does the intrinsic value of the company is high enough to justify the present price levels in the stock market. So these are the questions that you need to answer, and to answer these questions you will need to do fundamental analysis. Technical analysis will not do your work. So if you are doing fundamental analysis, only then you are investing. It is not that you cannot use technical analysis as a part of your research work. You can use, but the majority of your decision making should be based on fundamental analysis. And once you are convinced that this company is fundamentally strong, then you can go ahead and use technical analysis methods as well to time the market, whether this is the good time to buy or in future the price is going to go further down. This type of information you will get from technical analysis. Suppose a stock you have found that its intrinsic value is 100 and presently it is trading at 90 rupees. So it is an undervalued stock. You will like to buy that. But suppose upon doing technical analysis you found that it is going to further slide another 10 rupees in next few weeks or months. So that will tell you that you can wait. Why to buy stock at 90 when it is going to be available at 80? So technical analysis you can use, but primarily an investor's decision is driven by fundamental analysis. Point number three, what kind of asset you are buying will decide if you are investing or speculating. Suppose you are buying an asset like a stock, you are buying an asset like a real estate. What is unique about these two assets? These two assets generate cash flows for its investors. For example, stock generate cash flows in the form of dividends or in the form of free cash flows. Real estate generate cash flows in the form of rental income. But suppose you are buying an asset like a Bitcoin, you are buying an asset like gold. These assets does not generate any cash flows. Suppose tomorrow the stock market closed down. For some reason, the stock market is not working maybe for next 10 years. Does your stock holding stop generating returns? No. The businesses, the underlying businesses behind that stock will continue to operate. Those businesses will continue to make sales and profits. They will continue to give you dividends. So even if there is no stock market, even if there is no trading, you will still make money out of your stocks. Suppose you have a real estate property. How you make money? Your tenants give you rent. So that's why these kind of assets which generate cash flow for its investors, real cash flows, they are not speculative assets, they are investable assets. So if you are buying an asset which generates cash flows, you are actually investing. But if you are buying an asset like a gold, suppose you buy a physical gold and keep it in your locker, will it generate any cash flow for you? Real cash flow. I'm not talking about only capital appreciation. Real cash flow. It is not. Suppose you buy a Bitcoin and there is no Bitcoin exchange. Will it generate any cash flow for you? No. So the type of asset that we buy will also decide if we are investing or speculating. The fourth difference is the investment horizon. Suppose you are buying a stock after thorough analysis. You know the business, you know everything about that company, you know the intrinsic value, you have done all the analysis, but your intention is to hold that stock only for few months and then sell it for profit. You are actually speculating. When the investment time horizon is too small, it is an speculative activity. When you are buying a stock, suppose you are buying a stock like a Britannia Industries and your intention is to hold that stock for next 10-20 years, then you are investing. You are doing a self research, and upon that self research you found that stock attractive and you bought that stock with an intention of holding it for a very long time, maybe for decades. Then that case, your stock purchase activity will be called as an investment activity and it will not be a speculative activity. The final point is the mindset with which you are buying a stock. An investor, if he is buying a stock with a business mindset, only then it will be called as an investment activity. Otherwise, it is a speculative activity. Suppose you have two companies, A and B, and your intention is to buy either of the two companies. You want to buy the whole business, not a stock, the whole business. What you will think then? Before buying the whole business, you will see whether what is the business model of the company, who are running the company currently, who are the top managers, what are its sales, how much profit it is making, whether its profitability is high enough, whether it has sufficient reserves or not, whether its assets are generating enough returns or not, whether it is generating enough cash flow from its operations, whether it is able to generate free cash flows. So you will see all these aspects and then you will decide that whether this business is worth investing in. So you are actually thinking like a businessman. You are actually analyzing the business quality of the company and then you are deciding whether to buy that company or not. But if you are buying a company just from the perspective of a stock purchase, then it is a speculative activity. You are not thinking about the underlying business. You are only thinking that I'm buying this stock, maybe I will hold it for next 5-10 years and then I will sell. You are not actually bothered about the underlying business fundamentals. Your thought process, your mindset is to buy, hold and sell. Even in this case, you are speculating, you are not investing. So in order to invest, you have to think like a businessman. You have to think that whether that business is good enough or not. And if that business is good enough, suppose you buy Britannia Industries today. After 10 years from now, Britannia Industries continue to do good business. Why you will sell the stock after 10 years? You will continue to hold. So this is the way you are thinking like a businessman. You're thinking not a company as a stock, but as a business. Till the business is strong enough, you will continue to hold. Maybe that time horizon becomes 20, 30 years. Who cares? Till the business is strong, you will continue to hold its stock. So this is the kind of mindset you should have. And only if you have a business mindset, you are investing, otherwise you are speculating. So I hope you like this short video on investment versus speculation. And if you like the video, please give it a thumbs up and please do consider subscribing to my YouTube channel. Thank you very much for watching.